This is the Times Television Network, and you're watching ET Now.
Let's get another opinion on global markets. Sanjay Guglani, who's CIO of Silverdale Capital, joins in with his perspective. Sanjay, good to have you on the show. The U.S. job growth accelerated sharply in May and wages picked up as well. How do you read this as an indicator for a potential rate hike by the Fed in 2015 itself? Or the IMF is talking about the Fed looking at a rate hike, or should be looking at a rate hike only in 2016?
Well, the jury is still out. We have seen employment numbers which are much better than what was consensus. However, let's keep in mind that Fed has twin objectives, not only in terms of full employment, but also in terms of inflation. And inflation, even the CPI is around 1.8. And let's not forget that Fed looks into PCE, which is around 1.4, a long way to go. And we all know the difference between CPI and PCE being accounted for, the formula difference, the out of scope, and the weightages. So we still see a lot of way to go. Having said that, at Silverdale, rather than being lost in the semantics, we would rather focus in terms of optimizing risk-adjusted returns. And we believe that rather than being prepondered by interest rate risk, it makes tremendous sense to focus on credit risk, and hence adhering to short duration could be a good strategy.
How should an investor into emerging markets, particularly India, interpret the global data events? Should we expect that because of higher rate on the US 10-year yield, we should see some selling pressure?
Not exactly, and the reasons are twin. One is that if you look in terms of the emerging market per se, let's not forget that the divergence between the results of the top 10 percentile versus bottom 90 percentile is roughly about 100% as compared to 40% developed market. What it means is that for emerging market like India, it will continue to be a stock picker's market. Having said that, would there be impact of the Fed rate hike? The answer is yes, but not as significant as we saw at the time of the Fed taper tantrums, which we saw in May, June 2013. For India, of course, there are two positive facts to it. First, of course, the fact that the forex reserve for India is up from around 288 billion to about 354 billion now, which gives huge amount of external stabilities. And a second, of course, is the fact that India continues to be a very promising story among the emerging markets, given that the other emerging markets, whether Russia or Brazil, are bogged down by their soft commodity prices.
Give us also a view on what did you make of the RBI's hawkish commentary after the recent rate cut. Is there reason to worry about food inflation on the back of poor monsoons?
I think RBI told the obvious. They did talk about the food inflation and crude and external volatility. External volatility is something which we have to live with given the current low interest rate environment in the world. Crude, the new 70s, the earlier 900s, so we don't see a big deal in terms of crude spikes coming through. Coming specifically to monsoons, the jury is still out. We have different forecast, whether it's by the Australian, US, and the Indian Fed department. We do not know exactly how the El Nino will impact. We do not see it should be significant. Nevertheless, even if it was to be, given the fact that we have seen untimely rains in March and April this year, we would expect roughly about 10% approximately of rabi crops being affected. Or to put in other words, we are looking roughly about 40% cut in the GDP growth, which is important, which is significant, but not something which is so material that it would change the destiny of the country. Let's take a step further. Beyond the monsoons, the more important thing is to see what will be its impact. And if we are looking in terms of impact in terms of rural income, let's keep in mind that the rural inflation which we saw in last decade of about 11.25%, out of which almost 9.1% was accounted by the increase in MSPs and in terms of the employment guarantee scheme. The Modi government has significantly reduced this MSP to sub 5%. So we do not see that giving a spike there. Coming to the other aspect of DBT, which people are quite underestimating, because of the direct benefit transfer, the reduction in the leakages could be as high as 40%, which approximately means about $17 billion. So this is the amount which would, of course, we don't expect to be an entire 17 billion. Even if half of it comes through, we see a huge amount of containment in terms of inflation. What's going to happen is two things. One is that structurally speaking, the rural demand will trade downwards. So instead of easy money going into easy spending in terms of consumer durables, we would see essentials being more in demand. The second aspect of the change in the complexion would be in terms of the impact it would have on the auxiliary things. For example, in terms of the two-wheelers, etc. out there.
What about the just concluded earnings season? Has that put doubts on valuations being stretched at 14, 15 times roughly? People would expect that the Indian valuations are in a reasonable range.
Two aspects again. One is if you look in terms of the forward P ratio, we are talking about between 15 to 15.5, which is the discount to last 5 years P of 18 and significantly below the peak of around 25. So in terms of valuation, they are not very demanding. Coming to the recovery in terms of earnings, we would expect the earnings to start look up once we see uptick in terms of the government spending, and we are already seeing a bit of uptick there. So the real flow down into the earnings we should expect in starting from September and December quarter.
All right. Finally, Sanjay, is there more pain in the system? Do you think that there's more correction perhaps due for Indian equities?
As I told earlier, the emerging markets and India in particular continues to be a stock picker's delight. There would be segments which will go through pain, no doubt about it. But overall, the risk reward is more slanted towards rewards. And any investor who is looking to invest for about at least 6 to 8 months on the lower side should start looking, increasing the bets on India.
Sanjay, thanks very much for joining us with your views on the Indian market. Appreciate your insights.
This is the Times Television Network, and you're watching ET Now.